Hello everyone and welcome to your Glassnode video report for week 46, 2022. So I won't quite say that the dust has settled, but it's certainly more settled than it was in our last video last week talking about FTX kind of in the heat of the moment. Now that we've at least got a bit more of a picture, as we alluded to last week, it certainly doesn't look overly good. So what I really want to explore today is a bit about the fallout and really the bigger picture impact. What is the overall impact it's had on the rest of the industry? And as we often do with on-chain analysis, we are looking for the human psychological reaction. How has the industry and people responded to this particular set of events? So it has been a remarkable, it's a devastating event to happen. It's a real black eye for the industry. And again, let me just really say that anybody who's affected, it is such a real shame. And we at Glassnode wish you absolutely all the very best. These times are very challenging. The industry is all trying to, reeling from it and dealing with this process. But, as with free markets and as with Bitcoin, it is resilient, it has high resolve, it's robust, and it's not going anywhere. So we have a high degree of confidence that this market will come back stronger, as free markets tend to do. This is the forest fire that essentially flushes out all of the excess and all the malfeasance, and all of the bad actors get flushed out during this process, and the industry can rebuild stronger. So what I'm going to cover today is a few things. We'll start very high level on the FTX, the actual bank run itself. We won't spend too much time on that because we covered that in the video last week, which you will find a link in the description below. But we'll just explore a bit about the draining of wallets and kind of the status quo of that. But what I really want to focus more on is the wider impact. How have investors and holders across the rest of the industry responded? And particularly regarding the actual behavior regarding self-custody. Are we seeing more people taking custody of their assets? Or is this an enormous panic and everybody's saying, get me out of here? And the last thing we're going to look at is the actual impact on Bitcoin's long-term holders. So really exploring what the strongest hands, how have they responded to this whole event. There's always going to be a degree of panic, and as data starts to evolve and we get a couple of weeks worth of things, we can start to see these behavioral patterns and trends. Is it a shock event, or do we actually have a widespread loss of confidence? These are some of the things we'll cover, and let's get started. Okay, so here we are in the week on chain 46 dashboard, and what we're looking at here is the price chart for Bitcoin, Ethereum, and FTT. Over the course of the last month, and you can see how FTT was really this, really the linchpin that blew everything up, where essentially the collateral value fell at a very, very rapid rate, and that happened to be the collateral that a great deal of FTX and Alameda's business was essentially hinging onto. So the collapse of that resulted in about a 25% decline in the price of ETH, about a 21% decline in the price of BTC, and obviously all of the other market-wide impacts. Now, we did cover the actual mechanics and some of the details about the flow of funds and a bit more about the lead up in a video that we released last week. And on this dashboard, you'll also find a link to a Twitter thread put out by Glassnode's main account, and also a dashboard with the relevant charts from this video. So I'll let that particular set do the talking, and we'll spend a little bit less time talking about the FTX debacle and a bit more about the wider market impacts. Now, on the FTX balance sheet and the overall behavior of that exchange specifically, what I did just want to touch on is we've got the balance on exchange for Bitcoin and ETH in these two instances. And what I really want to zoom into is the sell-off that we had back here in June that took us below the $20,000 level for the very first time. Note that the BTC balance on FTX declined from 133,000 down to around 70 or 65,000 BTC in a very, very rapid move. Likewise, with the Ethereum balance, it declined by about 55% following the June sell-off. So almost 50% or more than 50% of their BTC and ETH came out of their balance during that time. And then you can see the final bank run in the late stages of this week. So you can really see that it's kind of gone down in two different legs. But since that initial June sell-off, the BTC balance has been in perpetual decline. The ETH balance has been in perpetual decline. And interestingly, their stablecoin balance jumped on FTX across all these stablecoins and kind of held about a $700 to an $800 million level until it too drained to zero during the bank run. Now, what this really describes is that it's highly probable that their balance sheet was actually impaired as far back as June or even back as May when Luna sold off, and that blew up a series of other companies that they were associated with, various other lenders, And as a result, this event, this failure of FTX, may well have been baked in the cake since as far back as May or June. And we're really seeing that final flush out of all of the chaos that actually stemmed from the 3AC blow up and the Luna collapse and all of that contagion. This could in fact be just the tail end of that contagion itself. So you can see that there was clearly something that had changed, whether it was BTC and ETH were provided to a lender as collateral for stablecoins at that time. But as you can see, all of these balances have effectively declined to zero. So that really is kind of the end of the FTX saga as it stands at the moment. Obviously, it will take some time for all of the reality to come out, but certainly when it comes to their on-chain wallets, most of these appear to have gone to pretty much zero. So now I want to move on and look at the broader market impact. How has the market responded to this particular event? And what is the take-home message? And what we can see here is up the top, we've got our Bitcoin balance across all exchanges and our ETH balance across all exchanges. Now that's what the actual line traces are showing. And in recent weeks, you can see that we've seen the BTC balance decline by about 73,000 BTC, one of the largest 1 week moves that we've ever seen. And the Ethereum balance has also declined by about 1.1 million ETH. So a truly extraordinary flow of funds out of exchanges. And what we also have here are these area charts, and these are showing the 30-day net position change. And these are also some of the largest, certainly in this cycle, going back more than 2 years. This is the largest exchange outflow that we have seen for BTC, and likewise for ETH. So we're seeing a very, very significant rate of change. Lots of BTC and ETH are flowing out of exchanges at the moment, and that kind of sets us up for the next phase. Now, on the stablecoin front, we actually saw one of the largest net inflows. Over $1 billion worth of stablecoins flowed into exchanges on the 10th of November. And this has actually pushed our overall, the red curve here is our all stablecoins, looking at Tether, USDC, BUSD, and DAI. If you compare these top four, and by the way, these account for about 99.5% of all stablecoin balances, so we're looking at the vast majority here. Until very, very recently, this actually pushed it to a new all-time high of about 41.1 billion stablecoins on exchanges. That's only on the Ethereum side. You can also see a growing dominance of BUSD, a slight decline in Tether, and a notable decline in USDC. So clearly this is representing also a bit of a consolidation of overall market share by the Binance entity and the BUSD entity. Nevertheless, what we can see is that there is an inflow overall of stablecoins to exchanges at the same time as we have BTC and ETH flowing out, which is quite an interesting development. So where are these stablecoins coming from? Well, this chart here is looking at the supply of stablecoins in smart contracts, and we're looking at a 30-day net position change here. And what you can see is that we're seeing somewhere between $4.8 and $4.6 billion worth of stablecoins coming out of Ethereum smart contracts and thus moving into exchanges. So it's quite interesting that we're actually seeing people grasping for liquidity, pulling dollar liquidity from wherever it exists. This is draining money out of smart contracts. There could also be an element here of a bit of concern. Maybe it's around the actual stablecoins themselves, because there's obviously custodians and central issuers here. There's also potentially just fears of contagion, where the market makers are going to have to pull out of some of these DeFi protocols. There's just a general risk-off sentiment. What appears to be the interesting dynamic here, however, is that what we're seeing is an actual divestment, or appears to be a divestment of stablecoins and a preference for the trustless assets of BTC and ETH. So people are essentially pulling stablecoins from wherever they can, sending them to exchanges on net, and actually withdrawing the two trustless base assets, which is quite an interesting change, or certainly a market dynamic to pay attention to. Now, this model here is essentially combining all of that we just talked about into one particular model, and we call this the exchange buying power. Now, what this is looking at is a two-part model. The first one is that this orange barcode will show up when over a 30-day period, there is more BTC and ETH. When you combine those two majors together, let's look at all the BTC and ETH flowing into exchanges on a USD basis. Is on the 30-day basis, it inflows or outflows? It will be, if it's orange, it means that we are seeing an inflow of coins. Now, right now, you can see that there's clearly an outflow, so we do not have an orange bar. So there's an outflow of the two majors. So now what we do is we subtract the amount of stable coins flowing in. If there's $1 billion of stable coins flowing into exchanges and $500 million worth of BTC and ETH combined, then you've got 500 million, half a billion of excess stablecoin buying capacity. So it's kind of subtracting away the inflow, assuming that stablecoins are buy pressure, assuming that BTC and ETH are sell pressure, subtracting those two from each other. Again, it's not a perfect model, but we're looking for the macro flow of funds. And what we can see here is that on net, it's about $4.8 billion in excess stablecoins flowing into exchanges. So this value here, you can see, is actually pretty much the opposite of the stablecoins coming out of smart contracts. So we are essentially seeing that BTC and ETH are coming out, stablecoins are going in, and those stablecoins are more or less coming out of smart contracts. So it's this very, very interesting move towards self-custody, and specifically of the trustless two assets, BTC and ETH, which is quite an interesting trend to observe, and one that we can pay attention to over coming weeks and months. Now, what I also want to just touch on is a couple of dashboards. So pretty much everything that we've just gone through, and including the charts we're about to go through, most of these are actually sourced from our existing dashboards that we've recently rolled out. I want to give you a very quick fly through of some of the tools that I use to actually build up this particular report so you can see where they came from. So the first one we're going to look at is our address cohorts, which you'll find over here and under our Bitcoin tab for address cohorts. This is essentially looking at the address count for plankton and shrimp and crabs, and essentially stepping up through the different wallet cohorts. We can see here for crabs, the address count has essentially been hockey sticking. And this down the bottom here is the 30-day change in address count. So you can start to see when you're getting changes in various address cohorts. Are we seeing more crabs coming in, more sharks, more fish, more whales? We can essentially look at these different cohorts to assess what is their overall behavior and what does that tell us about market structure. Now we're going to cover all of these metrics in detail in the next section on the week on chain, but this is essentially the professional version. So that address cohorts is available for advanced members. This one here is then our entity adjusted data and specifically looking at the coin supply flowing in and out of these different entities. And again, we're looking at shrimps, we're looking at crabs, we're looking at how much supply is moving into these different cohorts. And obviously we compare that alongside things like our whale flows. We can compare it with our exchange flows, miners, where are those coins coming from, where are they heading to, and looking at the overall distribution of funds through the system. And the last one that I want to touch on is the HODL wave dynamics. We're going to touch on this at the end of the report, but very much trying to assess what's going on with the young coins, the middle-aged coins, short-term holder coins, looking at the overall spending patterns of these coins younger than 6 months. Then there's the converse. What are the old hands doing, the long-term holders? What's the long-term holder spending pattern look like? Net position change for that particular entity, and then also looking at ancient coins, right? We've seen a handful of these ancient coins older than 5 years coming back to life, but at the same time, we want to see whether this actually picks up and maintains any level there. So really, these are trying to capture a few different elements. We've obviously also got our exchange dashboard to actually track the balances of these different groups, so you can really assess the flow of funds, the age of funds. But really, these tools are set up to give you the tools to answer these questions, particularly during tumultuous times like this. So essentially, it's the toolkit is there and ready to go. Anyway, let's jump back into the analysis and keep going. So what we're looking at here is, we talk about this a lot when we look at on-chain analytics. It's behavioral, and we're looking for changes in investor behavior. So here's FTX's failure. You can see here, we're looking at the trend accumulation score. Blue means balance increase, red means balance decrease, and yellow is essentially neutral or flat across that cohort. And down the bottom here, we've got less than 1 BTC. These are the shrimp, all the way up to the mega whales greater than 10K. Now, here's FTX's failure. Everything has essentially transitioned into balance increase. So we have seen that there's clearly a very, very direct response from the market to this particular failure. The market has changed their behavior patterns, and really that's what makes it interesting. Now we can start looking and assessing what goes on now that we've got this very, very clear change in psychology. So essentially stepping through these different entities, we've got the shrimp here. These are folks with less than 1 BTC, and we can see that this is essentially pushing up to almost a new high. Let me actually pull this out on a 5-year basis. The last time we saw values this high was the December 2017 peak, 20K. We saw it again at 20K, just this time from the downside. And here we are pushing to pretty much the same level. So we're talking about 51.4 thousand BTC moving into shrimp cohort. This was as of Sunday. So this number is actually going to be larger at the moment. So you can see here the actual rate of increase here is 58,400 BTC per month. So a very, very significant amount of funds flowing into the shrimp cohort, and really goes to show just, kind of the magnitude of what's going on. You can see the hockey stick behavior. And you can see here that this trend is being replicated across all of these cohorts. Here's how crabs, 0.1 to 10, you can see this is also climbing quite significantly. 48.7 thousand BTC as of Sunday. The fish to sharks, now this one's quite interesting. These are 10 to 1,000 BTC. This kind of represents the high net worth individuals, the trading funds, folks who have a reasonable amount of coin to move around. Now, they have been one of the least participatory. Let's just quickly jump back up to our accumulation trend score. Here they are in the middle. They've kind of been fluctuating between somewhat neutral. There hasn't been much going on, a bit of distribution, kind of flat for several months. So they've actually been participating the least. It's been declining over time. Overall net balance increase, but not by much. These guys have really entered the fray. So we are really seeing that flow of funds into these self-sovereign wallets. So it really shows that people are moving towards that self-custody model in the wake of this and just allowing the fire to burn through. Now, the whale cohort, they've actually been on the accumulation for some time, really since mid-October. They've been adding to their balance at a significant rate. They reached 77,500 BTC, or actually more, 79,000 BTC per month. It's softened off just a little bit, but they're still adding to their balance at a rate of about 53,000 BTC per month. So very interesting across the board, whether you're a whale or a shrimp or a crab, we are seeing all of these balances starting to tick higher in the wake of this FTX disaster. And again, it goes to show alongside that stablecoin data we looked at before, there's clearly a change in investor psychology. And that's kind of what makes this, this whole field very interesting, is looking at the changing flow of funds through the system. Now, on the other side of that equation, there's the poor old miners. Now, we covered miners a couple of weeks back saying that hash price was pretty much at all-time low, and that's before the whole FTX event. Miners have distributed close to 8,000 BTC at this point in time. You can see that their distribution pattern is pretty much the largest we've seen since September 2018. So miners are under an immense amount of stress. They currently hold something like 75, I think, about 75,000 BTC on the wallets that we track. And they remain under immense stress. So miners are most likely to remain in that very, very distressed domain. And with many of them publicly traded, we will see how that plays out in capital markets and debt markets. But overall, the miners do remain a cohort to be somewhat concerned about in terms of their balance sheet. Now, the last thing I want to close on is the overall long-term holders. What are Bitcoin's strongest hands? What is their response to what is a truly dramatic event in this space? Now, the long-term holder supply, I've got two metrics here. One's just their raw balance. Now, you can see they've essentially, now remember, this is not accumulation. When you're seeing coins on the long-term holder supply climbing, these are coins that were acquired 5 months ago and they're maturing across that 5-month barrier. So they're coins that have been held for that period of time. So really, this represents buying power from the past. Now, conversely, whilst uptrends take time, take a minimum of 5 months or 155 days, spending is immediate. So when we see spending from the long-term holder cohort, that is showing that we are having an actual immediate spend, because they go from 5 months old to 24 hours the moment that transaction gets confirmed. So spending is immediate, maturation takes time, which is why that HODL wave chart, by the way, that HODL wave dashboard is designed the way it is. You can track the spending that's immediate, and you can track the flow of funds as they migrate through different age brackets. So anyway, what we've seen is a very, very slight, on the grand scheme of things, a very small decline. Now, this small decline is about 61,500 BTC, so non-trivial. And you can see here, here's our 7-day change. It's also not the most dramatic. We've seen much larger long-term holder flush outs over recent times. You can see actually during bull markets is when they spend the most. So whilst it's significant in the sense that it shows up, it's not necessarily the most. It's an event, right? We haven't yet seen whether this becomes a trend. So really, if it's an event, that's typical. That's a capitulation event. Someone has to cover margin calls. There's always going to be elements, and there's always going to be somebody who must exit their position or loses faith or whatever it is. What we're looking for here is a sustained trend. So remember, this is only in the wake, right? FTX only just collapsed. We have to pay attention to these types of metrics over coming weeks. And that's why I wanted to highlight that HODL wave supply dynamics chart, because for advanced members, you'll be able to track what's going on with those older coins using that tool. So trying to understand what's going on with this flow of funds over the coming weeks is really important. So within that frame of reference, we can then look at the weekly sum. So over the last 7 days, how many coins that were older than 1 year, right? These are kind of the coins that have been held long enough that they're kind of discounted a bit from the market. How many of those 1-year-old coins were spent? And we've normalized this into a statistical basis using a Z-Score. So what we're looking at here is when you get these green zones, it means it's more than half a standard deviation above the mean, and red is half a standard deviation below the mean. So the other way to think about this, red zones is when the market is very quiet. Very, very few old coins being spent, and that's kind of been the norm through most of 2021 and 22. These green patches, you can see here again, during the bull market, this is when long-term holders are cashing out and taking profits. So big green bars are capitulation style events or bull markets where they're liquidating into strength. Now you can see, much the same as long-term holder supply. It's green, it's there, but it's also not really knocking it out of the park. If this evolves into a much longer term trend, then we start talking about, okay, perhaps there actually is something concerning here. But for now, it's not, it's more of an event. It still sits in that event camp, but it's one of those metrics that we can pay attention to and track over the coming weeks to see whether it actually metastasizes into a much, much larger loss of faith, or if it really is a capitulation style flush. Now, if we look at our dormancy metric, this is the average age of the coins that were spent in days. You can see that we've essentially pushed about 90 days or 3 months on average. So the average coin being spent was 3 months old. And you can see that this is essentially in line with the bull market back here in 2021. You can see it's in line with the previous capitulation style phases. So again, it's non-trivial. But what we kind of want to see is, does it actually reverse back down? Is it an event? Or is it something that's actually forming some kind of a longer term trend? Because a longer term trend would suggest a widespread loss of conviction. An event is an event, and then the market can move forward. So these are some of those things we can track as we move forward into the coming months. And to avoid kind of repeating myself yet again, we've also done this for coin day destruction. So the total volume of coin day destruction, you can see again, it looks at the moment like an event. We will see if this actually turns into more of a trend or if it really is a capitulation style wick, because again, that will represent the same as what we've just said. Now, what we saw is about 165 million coin days were destroyed during this week. Now, this is equivalent to 452,000 BTC that were held for 1 year being spent. So that gives you a bit of a scale on kind of the amount of spending that happened across the entire market. So we had 452,000 equivalent BTC, and imagine if they were all held for 1 year. That's essentially how much spending was ejected from the market. So it kind of gives you a bit of a scale of things. Clearly, it shows up. It's on par with any of these previous capitulation wicks. Generally speaking, in bear markets, this is what we see. We see these large-scale events that kind of create some kind of momentum in some direction. You can see here that we reached a period of consolidation following this one here. During our sell-off back here at the start of the year, we also entered a consolidation phase. So quite often these events move the market into some kind of new regime, whether it's a consolidation before the next trend, or if it's actually a reversal in the other direction. So generally speaking, these events highlight that something has changed, investor psychology is now different, and we have to thus assess what happens moving forward. So thanks as always for jumping into this, folks. Hopefully you enjoyed that session. As I said at the start, please, I really do hope that everybody's okay. I know these times can be very, very challenging. We wish you absolutely all the best. If you have any questions at all, you can reach us in our YouTube comments. You can also reach us on Twitter. More than happy to answer those. And again, we're really trying to make sure that these dashboards provide you with the tools to answer your questions. The metric of the week is that exchange buying power. You'll find this in our dashboards under market, stablecoins, and exchanges. So we've tried to group all these together to really contextualize what's going on, give you the toolbox so you can pick up the right tools at the right time to answer the questions that you have. Anyway, feel free to grab me at any time, and I'll see you in the next one. Cheers.